Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden messages in corporate filings. And today we're diving into Creative Realities Inc., a company that's making some interesting moves with its credit line. This report is all about a new amendment to their credit agreement, which sounds a bit dry, but trust me, it tells us a lot about how the company is managing its money and its ability to borrow. So what's the big news here? Creative Realities and First Merchants Bank have signed a second amendment to their credit deal. This basically means they're tweaking the rules for how much money the company can borrow and how that amount is calculated. This amendment specifically changes something called the borrowing base margin. Now, the borrowing base is a fancy term for the maximum amount a company can borrow based on its assets and what the bank thinks those assets are worth. Think of it like a credit limit that goes up and down depending on the company's financial health and the value of its collateral. What's really interesting is how this margin is changing. Starting from late October this year, the percentage of the company's eligible assets that counts towards this borrowing base will drop from 90% to 85%. This might seem like a small change, but it directly impacts how much cash Creative Realities can access from its revolving line of credit. This isn't a massive change in the grand scheme of things, but it signals a slight tightening of credit terms, or perhaps a more conservative approach from the bank as we move into late 2025. It suggests that the bank is re-evaluating the value of the company's contracts as collateral. Creative Realities' main stock is listed on the NASDAQ under the ticker CREX, and it's important to remember that changes to credit lines can affect a company's flexibility in funding operations or pursuing new opportunities. For a company like Creative Realities, which is in the business of creating digital experiences for retail and other environments, access to credit is crucial for growth and managing day-to-day expenses. This filing is primarily about that second amendment to the credit agreement, which you can find as Exhibit 10. One, it's the document that lays out these new borrowing base calculations and percentages. Now, for my take on all this, while the specifics of borrowing base margins can be a bit technical, the core message here is about access to capital. Creative Realities is adjusting its credit terms, which is a normal part of business. However, the reduction in the borrowing base margin starting in October indicates a potentially more cautious lending environment for the company from its bank. This could mean they need to be more strategic about how they use their credit line or potentially explore other financing options if they plan significant expansion. The key takeaway is that companies, even profitable ones, rely on credit, and the terms of that credit can matter a lot. It's like having a credit card with a slightly lower limit. It doesn't mean you're out of business, but it does mean you need to manage your spending more carefully. Looking at this filing, it seems Creative Realities is adapting to shifting financial landscapes. For investors, this is a signal to keep an eye on how the company manages its liquidity and debt in the coming months. What's your take on these credit agreement changes for Creative Realities? Do you think this will impact their growth plans? Let me know your thoughts in the comments below. And if you found this breakdown helpful, please give it a thumbs up and subscribe to Corporate Decoder for more insights like this. Also, make sure to join our Discord community linked in the description for even more in-depth discussions. Thanks for watching, and we'll see you in the next Decode.